All right, get ready. We're diving headfirst into the world of Vistra Corp today. We're taking apart their latest financial report, and trust me, this is not your typical boring corporate stuff. Whether you're prepping for a big meeting with Vistra or just really curious about this energy giant, think of this as your secret weapon to sounding like you rode the whole thing. Get this, they have a facility that actually turns trash into energy, and their risk management, top-notch. They definitely learned some lessons from Winter Storm Uri, ready to get energized.
Vistra is way more than just lights and power lines. We're talking a company with a huge reach.
No kidding. I had no idea. They operated in so many states with all these different brands under their name.
They've got household names like TXU Energy in Texas, USG&E across multiple states. They've got the market covered. But wait, there's more. They even have these value-based brands, things like For Change Energy, Express Energy, Veteran Energy. Talk about knowing your audience.
So it's not just one massive company. It's like different sections all working together.
Right. The report mentions retail, Texas, East, West, and even a mysterious sunset segment.
Yeah, think of it like a whole energy ecosystem. Vistra's got a hand in every part of it. Retail is all about connecting directly with everyday customers, like you and me. Then you've got Texas, East and West, where they're running power plants and selling electricity wholesale, even to their own retail arm. It's a really interesting cycle.
And sunset. That sounds kind of ominous.
That's where Vistra puts assets that are on their way out, like older power plants nearing retirement. I guess it's a gentle way of saying goodbye to the old stuff.
Now, this is where things get really interesting. The report mentions these things called nuclear decommissioning trusts. What are those, and why should we care?
Nuclear decommissioning trusts, they're like a long-term savings account for the inevitable, but really messy job of dismantling nuclear power plants. We're talking a seriously complex and expensive process.
And they're passing these costs on to Texas consumers through a surcharge on our electricity bills. Yeah, think of it as paying it forward. The money goes into these NDTs. It makes sure the funds are there when a plant, like Comanche Peak, reaches the end of its life. It's just one example of how Vistra juggles complex regulations and long-term financial planning.
So it's not just about keeping the lights on today. It's about planning for decades down the line. Now let's take a look at their financials. Are they raking it in, or are things a little dim?
Well, for the 9 months ending September 30th, 2024, their net income saw a big jump compared to last year. Part of that's thanks to those NDT gains we talked about. Plus, some smart moves with interest income.
Sounds like a healthy profit. But the report also mentions higher interest expenses. What's going on there?
Like a lot of companies, Vistra is feeling the pressure of rising interest rates. That, coupled with higher average borrowings, means their interest expenses have naturally gone up a bit. It's a balancing act, really.
Makes sense. Speaking of balancing acts, running a company like Vistra isn't just about profits. It's about navigating risk. And this document goes deep into how they assess and manage it all.
Risk is just part of the game in the energy sector, especially when you're dealing with financial instruments and assets with a limited lifespan. Take those acquired derivatives they mentioned, for example. Vistra uses something called Level 3 valuation for these, which involves complex models and a bit of educated guessing.
So they're using fancy techniques to estimate the value of these contracts. But it's not an exact science.
Exactly. And for those looming asset retirement obligations, think power plant shutdowns. They're using discounted cash flow analysis. They're basically predicting future costs and then adjusting them to their present-day value.
It seems like they're doing everything they can to manage uncertainty.
They're trying to. But let's be real, those future assumptions always come with a bit of risk. Now, let's talk about something that might seem a bit dry at first, but trust me, it's important. Credit agreements. The document highlights a recent change to one of Vistra's agreements, and these things can be pretty telling.
Oh, what kind of insider secrets are we talking about here?
Well, this Eighth Amendment to their credit agreement, specifically the increase in revolving credit commitments, could be a sign of things to come.
Hold on, back up. What does increasing revolving credit commitments even mean?
Think of it like a bigger credit card limit for Vistra. It could mean they're expecting to need more cash on hand, maybe for acquisitions or investments down the line. And just look at the list of banks involved. Citibank, Bank of America, JP Chase. We're talking big players here.
So this amendment isn't just a minor tweak. It could be a sign of major strategic moves on the horizon.
Exactly. Whether it's about fueling growth or responding to a shifting economic landscape, Vistra is playing their cards close to the chest. But this amendment gives us a little peek behind the curtain. Now, we can't talk energy without talking about the EPA, right? They recently announced new rules about coal combustion residuals, which, as you can imagine, made some waves in the industry.
Coal combustion residuals, or CCRs, are basically the leftovers from burning coal for electricity. What's the big deal with these new rules, and how is Vistra handling it?
These regulations are a big deal for any company that relies on coal. It impacts costs, public image, everything. The EPA has identified 10 potential units at Vistra that might fall under these new rules, but the full impact is still unknown until they finish their evaluations.
So, a lot of uncertainty hanging over Vistra's head, but the document mentions they're not just sitting back, right? They're challenging these rules in court, alongside a bunch of other companies and even some states.
It's a power move for sure. This legal battle shows the complex relationship between industry giants and regulatory bodies. The stakes are high. The outcome could have huge implications for Vistra's future.
Okay, let's move on from regulations for a minute.
Yes.
Let's talk about something I find super fascinating, commodity hedging. The document explains how Vistra uses these financial tools to basically deal with the crazy price swings of things like natural gas and electricity.
Commodity hedging is super important in a market as unpredictable as energy. Imagine trying to budget when the cost of your main ingredients changes all the time.
So how do they actually do it?
They use derivative contracts, things like futures, options, and swaps, to lock in prices for commodities like natural gas, electricity, even coal and emissions. It's like a giant insurance policy against market chaos.
And they're hedging against almost everything. The document even mentions counterparties like other energy companies and financial institutions.
It's a high-stakes game, with Vistra trying to anticipate and reduce the impact of price changes, especially as energy demands and climate concerns keep increasing.
Speaking of things heating up, Vistra is making some bold moves to expand. Get this, they're planning to buy up the remaining ownership in a company called Vistra Vision.
Now, this is something to pay attention to. Vistra is on a mission to consolidate its holdings, and this move shows a definite strategy.
So, what is Vistra Vision? And why is Vistra so eager to own all of it?
Vistra Vision is all about the future, renewable energy and sustainable technologies. By acquiring the remaining shares, Vistra is sending a clear message, a message about their commitment to a cleaner energy portfolio.
We're talking big money here. The document outlines a $3.248 billion cash transaction with Nuveen and Avenue. It's expected to close by the end of the year. This isn't just a casual investment, it's a statement.
It certainly is. This acquisition adds a whole new dimension to Vistra's story. Is this a major shift towards renewables, or just a strategic move to diversify their portfolio and tap into a growing market? Only time will tell. But one thing's for sure, Vistra is a company on the move, and they're not afraid to make big changes. Yeah, this acquisition could really change things. As the world moves towards cleaner energy, Vistra is putting themselves in a position to be a major player in that shift. But it's a tricky balancing act, wouldn't you say?
Totally. They're still heavily invested in traditional energy sources like coal and natural gas. Remember that legal fight they're having over the EPA's coal combustion residuals rules? Looks like they're trying to play both sides.
Yeah, it's a tightrope walk a lot of energy companies are dealing with, balancing their old assets with the push for a greener future. This tension's not going away anytime soon. But let's look at the numbers for a minute. This financial document's full of them, but I'm sure you can help us figure out the interesting stuff.
Okay, hit me with those numbers. We know Vistra's huge, but how huge are we talking?
Well, let's break it down by those segments we were talking about. For the 9 months ending September 30th, 2024, the retail segment brought in a whopping $9.913 billion in operating revenue, and the Texas segment wasn't far behind, pulling in $4.716 billion.
Wow, those are some serious numbers. Vistra's clearly a money-making machine.
And their net income for that same period tells an even better story. Vistra's total net income hit $2.322 billion, a big jump from last year. Gains from those nuclear decommissioning trusts and strong performance in their Texas and East segments played a big part in that.
Now, the document throws around terms like EBITDA and adjusted EBITDA. I'm not going to lie, those acronyms always confuse me a little.
EBITDA earnings before interest, taxes, depreciation, and amortization. Think of it as a way to measure a company's operating performance without all those non-operating expenses making things messy. Adjusted EBITDA takes it a step further. It removes things like one-time charges or gains.
So it's a way to see their core profitability
What?
without all the extra financial stuff.
Exactly. And for those 9 months ending September 30th, 2024, Vistra's adjusted EBITDA reached a solid $4.409 billion.
Okay, so they're making a lot of money. But the report also talks about their debt and financing activities. And that's where things can get a bit complicated.
Vistra relies on a pretty complex network of credit facilities and financing arrangements to keep things running. The document mentions their Vistra operations credit facilities, which include a revolving credit facility and a term loan facility, giving them a lot of financial flexibility.
It also gets into the details of these credit facilities, including things like events of default and covenants. It's dense material. But I'm guessing these specifics are important for anyone trying to understand Vistra's financial health.
Absolutely. Knowing these covenants and default rules provides valuable insights into Vistra's financial stability and the protections that are in place for lenders.
One thing that caught my attention was the receivables facility. What's that all about?
A receivables facility is a common tool for companies like Vistra. It lets them borrow money against their unpaid invoices, basically getting access to cash flow more quickly.
Ah, so it's like a way to keep the money moving.
Exactly. The document says Vistra has a receivables facility with a commercial bank and had $750 million in outstanding borrowings as of September 30th, 2024. They even have a repurchase facility, which gives them even more flexibility to manage their cash flow.
It's like they have a whole toolbox of financial tools. The document also talks about managing counterparty credit risk, which sounds a little scary.
It's all about managing the possibility that a company involved in a financial deal might not be able to meet their obligations. Imagine a company going bankrupt and not being able to repay a loan or settle a derivative contract. That's counterparty credit risk.
So Vistra has ways to evaluate and control this risk.
They do, and the document breaks down their exposure to different counterparties. Interestingly, a big chunk of their exposure, $250 million, or 34% of their total net exposure, is with a single counterparty.
That sounds a bit risky, like putting all their eggs in one basket. But the document says Vistra considers this exposure to be within their acceptable risk tolerance.
They've probably done their research, looking at this counterparty's creditworthiness, considering things like credit ratings and their role in the market. It's a reminder that even with the best risk management, there's always some level of risk in financial deals.
Speaking of risk, the document outlines some of the major risks Vistra faces, and it's a long list.
The energy industry is inherently risky. You've got regulatory changes, market volatility, cybersecurity threats. Vistra's got a lot to deal with, but they've put different strategies in place to try and minimize these risks.
One risk that stood out to me was the potential impact of extreme weather events. They specifically mentioned Winter Storm Uri, which really messed up Texas's power grid back in 2021.
Winter Storm Uri was a wake-up call for the whole industry. Vistra, like many others, faced major challenges during that storm. Since then, they've been working to improve their preparations for future extreme weather events.
The document also talks about the risks associated with their nuclear power plants, things like accidents or security breaches.
Nuclear power comes with its own set of risks, that's for sure. Vistra knows they need to maintain the highest safety and security measures at those facilities. They have detailed emergency plans ready, and they work closely with regulators to ensure the highest safety standards.
It's good to see a company acknowledge the challenges and potential problems. Transparency is important, right?
Transparency definitely builds trust with investors and stakeholders. By openly discussing these risks and outlining their mitigation strategies, Vistra demonstrates a commitment to responsible and sustainable operations.
Okay, we've been really focused on Vistra's financials and operations. But the document also provides some insight into their corporate governance structure. What can you tell us about that?
Corporate governance is the system of rules, practices, and processes that a company uses to direct and control itself. It's like the framework for ethical and responsible decision-making.
So it's about ensuring the company is run in a transparent and accountable way, with the interests of shareholders and stakeholders in mind.
Exactly. The document highlights Vistra's board of directors, the people responsible for overseeing the company's management and strategic direction. It also mentions different committees, like the Audit Committee and the Compensation Committee, ensuring checks and balances within the system.
They also talk about preferred stock.
Yeah.
How is that different from regular stock?
Preferred stock is a type of investment that usually has a greater claim on a company's assets and earnings compared to common stock. It often comes with a fixed dividend and may have other special rights.
And the document gets into the details of their Series A, Series B, and Series C preferred stock. It even outlines their dividend rates and redemption options. It's like a crash course in corporate finance.
These details are super important for potential investors who are considering adding Vistra's preferred stock to their portfolio. Understanding the terms of these investments can help them make smarter choices.
Wow, we've covered a lot in this deep dive. We've explored Vistra's business segments, their impressive financial performance, their complex risk management strategies, and even peeked into their corporate governance structure. I feel like we just crammed a semester's worth of Vistra knowledge into our brains.
It has been quite a journey, hasn't it? We've seen how Vistra is navigating the challenges of a rapidly changing energy landscape, carefully balancing financial performance, risk management, and sustainability considerations.
One thing that really stood out to me going through this report is just the sheer volume of legal stuff involved in Vistra's operations. I mean, we've talked about those credit agreements, but it also mentions things like a tax receivables agreement and even a shared services agreement.
It really shows how complex their business is. All these agreements govern different parts of their operations, from financing and taxes to how different parts of the company share resources.
It's like this giant legal web holding the whole thing together. One that I found particularly interesting was the Amended and Restated Tax Receivables Agreement, or ANR, PRA as they call it. The document mentions Vistra buying back some TRA rights. Can you explain that a bit?
The TRA is a pretty complex financial tool. It lets Vistra essentially make money from certain tax benefits. By repurchasing these TRA rights, Vistra is basically consolidating their ownership and control over those benefits.
The document also mentions some changes to the ANR TRA, like changes to reporting requirements and transferability restrictions. Seems like they're trying to streamline things.
Yeah, it does seem that way. These changes could be part of a bigger plan to simplify their financial structure and reduce some of that administrative burden.
Okay, last but not least, there's one more thing I got to ask about. The deemed hedge portfolio. It seems to include contracts related to power prices in different regions, like PJM and NYISO. What's the deal with that?
The deemed hedge portfolio shows Vistra's sophisticated risk management methods. It's basically a bunch of contracts treated as one big hedging tool for accounting.
The document even has formulas for calculating the MTM amount for these contracts. I'm guessing MPM means mark-to-market. It's pretty technical. But it highlights how much detail goes into their hedging activities.
Yeah, it gives you a glimpse into that world of energy finance. Those formulas and calculations are used to figure out the fair value of these contracts, which is really important for accurately reporting Vistra's financial position.
Wow, this has been an amazing deep dive. We've explored Vistra's business segments, their financial performance, their risk management strategies, legal agreements, even their corporate governance structure. I feel like we just got a crash course on Vistra.
It's been great going through this document with you. We've seen how Vistra is navigating this complex and always changing energy world, trying to balance financial performance, risk management, and sustainability.
So for someone who's about to go into a meeting with Vistra, or just wants to sound like they know everything about energy, what are the key takeaways?
Well, the most important thing is Vistra is a giant in the energy world. They're involved in everything, from power generation and retail sales to developing renewable energy. They're financially strong, but they face constant challenges, like navigating complex regulations and managing the risks of a volatile energy market.
And we can't forget those strategic acquisitions, like fully taking over Vistra Vision. It really shows their commitment to a cleaner energy future.
Absolutely. Vistra is constantly adapting and changing, responding to market trends and new technologies. This deep dive has given you a good starting point, but remember, to really understand their path, it's important to stay updated on their latest moves.
Well, that's it for today, a deep dive into the world of Vistra Corp. We hope you enjoy the journey and learn some valuable insights, even enough to impress a seasoned energy pro. Until next time, keep exploring, keep learning, and keep diving deep.